Alright everybody, welcome back. So far we've been talking about taking the upside and choosing just one side. Now what happens if we want to take the bottom side? First, let's talk about how to build that. When you're working with a butterfly, if you're going to build your butterfly above price, you want to use the calls. If you're going to build your butterfly below price, you want to use the puts. You're still going to buy a butterfly. You will always buy to enter a butterfly. We never sell to enter. All right. So if my target is the bottom line, then I want to use the puts. And if my target is the top line, then I want to use the calls. And I'm always going to buy. Now, when we do build a butterfly, we sell the body and we buy the wings. Okay. And we want a total of 4 products, or we always want to match what we sell. In this case, I'm selling 2 for the body of the butterfly, and I'm buying 1 on each side of that. I never try to sell more than I'm going to buy. So if I wanted to double this trade, I could sell 4 and then buy 2 here and buy 2 there. And again, that would make me equal. I'm buying as many as I'm selling. We never want to make it unbalanced on the sell side. Okay? And that's because a broker doesn't want to let you sell a naked option. All right? The reason why is the upside is unlimited. If the market was to explode higher and you sold a call, there's no limit to how much loss you could take before that trade was shut down. If it fell to 0, at least that has an end, right? It goes no farther than 0. But on the upside, a market could run to the moon. We know realistically that SPY wouldn't run to 4,000, but in the unlikely situation that it did, you would be on the hook for the whole ride, at least until the market opened back up. The options market is only open from 9:30 to 4, while SPY is a 24-hour-a-day product that moves even at 2 in the morning. So in the middle of the night, SPY could go from 304 to 404, a $100 move, and you would not be able to get out of that option until the next day when the market opened at 9:30. Now, yes, there is lock limits and all kinds of things, even in the middle of the night, that in theory would try to protect you, but the market just doesn't want you to sell a naked call or a naked put unless it knows you can handle that kind of risk, and we just don't ever really want to mess with that. Okay? Now, in this example, I do have a put, and what I want to bring to your attention is a question. In the previous video, we were willing to risk $100, and we picked one line. What if I'm still willing to risk $100, but I want to pick both lines? Well, that's what I went ahead and did here. I reduced the call spread, and I built a put spread, and combined, I'm risking $99. So if I'm wrong, if SPY reaches above $323 or below $301, I would be at a loss. If SPY stayed anywhere in the middle here, I would be at a loss. But if it lands on the line, on the bottom or the top, I'm a winner. Winner, winner. Okay? So what does that look like on the chart? So we can check that. We can say set slices to charts. Here is the current price of SPY. That's slice number 5. We don't really need that one. We'll just get rid of that. And now we've got our range where we would be profitable. Let's kind of zoom in on that a little bit. So in the trade that we built, if SPY lands on either of our low line or our high line, we are at max profit. If it lands anywhere in this area, we see some kind of profit. That's nice. That's not too bad. If we was to go back and run this kind of test, what would that look like? How many of those weeks would have been profitable if we had hit inside of this range? It's a good question. It's still risking the same $100. A combined risk, because remember, you can't win both. You can only win one of these two. Now I'm going to add an asterisk point here and say, depending on your broker, you can convert this. And when you do convert it, as long as phi is anywhere inside of the entire gray area that you see here, you would be profitable. Now, think about that for a moment. We can take our double butterfly and we can convert the trade into an iron condor. And when we do, if price is anywhere inside of that gray area, we win. So depending on who you're using for a broker, this is a converted double butter into an iron condor. And none of that is a losing trade. Anywhere in that gray area would be a winner. That is absolutely amazing. I want you to think about that for a little bit. Without that center, either one of these would be profitable. So you could build the double butter. And then maybe on Thursday or into Friday, you realize, uh-oh, SPY looks like it's going to close in this middle. Shoot, now what am I going to do? Both of my butterflies are losers. Depending on the broker that you have, you take those two butterflies and you rip them apart and you rebuild them into an iron condor. Now you're back into being a profitable trade again. You can't do that on Robinhood. So if you're doing butterflies on Robinhood, you will never get the chance to convert your two butterflies into a single iron condor. I shouldn't say never. If you're doing these on a monthly instead of a weekly basis, and you convert it early enough, then you can. But you can't do it on a Thursday night or into Friday morning. It won't let you. Okay. I think you can do it on Tastyworks. I'm not 100% sure. I do know for a fact that you can do it on Thinkorswim. I know that you can because I have done it. The very first time that I traded this butterfly strategy, I picked both. Not because I was trying to be slick, but because I took the trade live in the bullish bears, and I had already taken the top side and walked everybody through all the steps. And then somebody showed up in the room and said, "What did I miss?" And I started to explain it, and they said, "Well, I want one, but I really think it's going to go down, not up." And they said, "Well, just to make sure you don't trade it alone, I'll take the bottom with you, even though I already have a top one." And it was only risking $5, so, to make sure they didn't feel like they were alone, I took the bottom trade with them. Towards the end of the week, that trade was in the middle, and I thought, okay, being the way that I am, what can I do to this trade other than just eat a loss? And I got to looking at the spread and realized two butterflies can be converted into an iron condor. And so I did that, and I won. So I know that it can be done. It just depends on your broker. So when we're on the bottom, we use the puts. If we're at the top, we use the calls. In the last video, I already explained that a butterfly makes money sooner if you get a volatility crush. And we should not see volatility go down when price goes down. So the volatility crush will only help on the top side. And in that situation, that means that your best opportunity will always be at the top side. Now, that does not mean you can't trade the bottom. It is a profitable trade. But if you have to pick between the two and you're just like, gee, I don't know, it could go up, it could go down, I'm not feeling the force, I don't know which one it's going to do, I could literally just flip a quarter, I guess it don't matter. If you're in that kind of position, or you really just are agnostic and don't care, take the top. It's the better opportunity. Okay? Now, remember, we can take the entire thing. We can do it with a regular iron condor. We can build that iron condor from the beginning to take the whole thing. We don't have to choose. Depending on the broker that you use, you might have to pay fees or commissions to trade options. On Robinhood, it's free. The reason I bring it up is because we have 4 contracts. That's $4. If I'm building a $5 trade and I then have to spend $4 more to open the trade and $4 more to close the trade, then I'm spending $8 to build a $5 trade. Okay? Even 100% profit turns my $5 into 10, but I spent $8 out of that 10 in fees. You see how unrealistic that is? So this is one of the reasons I keep Robinhood around. It does have its value. Free trades. On Thinkorswim, I believe right now the price is 60 cents. On Tastyworks, it's 50 cents. Now, hold on. I know. It was $1 to get in and no commission to close. No fee to close. So if you just say round trip, it's 50 cents to get in, 50 cents to get out. That makes your $1 commission to get in, no commission to get out, right? Same difference. Either way you want to look at it, it's round trip a buck. At least that's what it was the last time I actually looked. And I can tell you, I don't look. I want the trade, I'm taking the trade. I don't care what they're going to cost me. I know they're not gouging me at Tastyworks. Okay? So I honestly don't know at this point in time exactly what their contract fee is. Heck, they might not have one anymore. I doubt that, but just saying. Okay, I'm going to stick to what I last looked at, and that was $1 round trip. That's 50 cents. 50 cents to get in, 50 cents to get out, $1 round trip per contract. A butterfly has 4. That's $4. Complete round trip. If I wanted to build 2, I'm now looking at $8. And I'm risking money too, right? Because one of those are going to lose at least, if not both. So if you start to get slick and you try to pick both sides, you really need to understand the fee structure that you're dealing with. Every broker has some positives and some negatives. Robinhood is free, but it's hard to see the options. It's hard to build the trade. You can't convert the trade on the last day. The only thing you can do to your options trade on the last day is close it, and they will auto close your trade within 2 hours of expiration if it triggers their automatic risk assessment program. Now, I've had issues with that risk assessment program that we could talk about some other time, but we'll just leave it at the fact that you can be in a trade and suddenly not be in it anymore at 1 in the afternoon on a Friday and find out that you were liquidated. They closed you down. Now, I demonstrated in the risk graph that at any point on Friday, if price is in that range, you'll be profitable. But if they close you down at 1 and you're at $50 profit and price is moving into the 10th or is already at the 10th, and we're going sideways into the close, another hour could literally be another $50. Another hour literally could be another $100. So it matters. It is uncomfortable to look over and realize your broker closed your trade and didn't bother to even ask you. So every broker has issues. Trading the double butterfly is best done with a broker that has a very cheap or free options structure. On Robinhood, there is no adjustment for your sell order. It defaults to a certain number. I've had people complain that they can't get out of a trade, and that's because Robinhood is trying to give them the best value. But it also unintentionally makes it harder for you to get filled, because then you're stuck working the order. We're going to be closing these trades near expiration, on the day of expiration, or maybe the day before, but most of the time in the afternoon, day of expiration. We can't be sitting there screwing around trying to get out of these trades. So I need to make it very clear. If you're going to trade this on Robinhood, you need to know how to work the order. If you're in a winning trade and your profit is $180, give away $1. Try to sell it $1 cheaper so that you can get out of the trade. Give away a little bit of that profit to get out of the damn thing. If you offer it at a cheap enough price, somebody will see that you're giving something away. You're giving it up cheaper than anybody else. You will get filled. Okay? And when you ask, well, why would I do that? Well, if you need out of the damn thing, it's in your best interest to get out of it. Don't let greed of $1 hold you back. And realize that if you had done the trade anywhere else, you would have been paying that dollar in a fee anyways. So don't let greed get you stuck in a trade just because you were trying to quibble over $1. If $1 doesn't work and you're still stuck and you have a profitable trade, $50, $60, $80, give away $2. Give $2 to get out of the damn thing. Heck, even if you only made $5, that it was one of those that wasn't a winner, but it just wasn't a loser, and you're looking at $5 profit. Give the $5 if you have to get out of the trade. Because I promise you the assignment fee is anywhere to $15 to $20 per leg. And there's 4 legs in a butterfly. You don't want to get stuck with a $60 fee because you weren't willing to give away $5. I can't stress this enough. Don't screw around on Friday afternoon. Get the hell out of these trades. So there is always the choice of doing the double butter. And you can also think of using 2 different brokers. So for an example, you could always do the top side on something like Tastyworks. And then if you're still interested in also doing the bottom side, you could do that one on Robinhood. Remember though, if you do the double and you can't convert it into an iron condor, then you are promising that one of those at least, maybe both, can be a loser. So when we look at the Analyze tab and we have 2 different butterflies here with a combined total loss of $100, you can lose the full $100. Okay, that is absolutely something that can happen. Don't tell yourself, oh, yeah, but I know, I can get out of this, though. I can get out early and, not eat the full $100 loss. You can get out early and not eat some of the loss. But if it's Wednesday afternoon and you're thinking, yeah, it looks like SPY's not going to make it into any one of these, and you cut your loss early, and then you watch SPY on Thursday and into Friday run right up to the center, you're going to feel like a turd because you bailed out of a winning trade trying to cut your losses. And don't tell me that it won't happen, because I promise you it will. SPY can easily go from the center of the expected move all the way to the edge of the expected move in a day. It can do it between Friday morning when the market opens and Friday afternoon when the market closes. It can make that run. I know. I've seen it do it. In fact, the issue with me and Robinhood, with their automatic risk assessment program, is because they killed one of my trades that made one of those moves on a Friday. So, we've now talked about the put side, and we've talked about the double butterfly. Remember that your better opportunity is to build an iron condor around the whole thing, rather than doing something like this. Okay? Or you're just better off taking the calls, and if it looks like price is not going to go to the upside that week, that you just don't put it on. Now, you can take the bottom and be successful. You just won't get the early edge that you could get from an increase in implied volatility the way that you would if you had only picked the top. One last thing that I'm going to mention, and then we're going to wrap this video up, is we've been talking about taking the top and taking the bottom. But there actually is one more choice. Take the middle. Where price closed on Friday is the center for the following week. That is one of the choices. That you literally believe that during the next week, SPY is going to move up and down and move around all over, but that it's going to end the week right where the week began. It does happen. It's not as common, but it does happen. It is a choice. The success rate is not near as good as picking the top and picking the bottom, or just always picking the top. Remember, the market is buoyant. It wants to go up. It's only because of negative news that the market goes down at all. So when the pressure from that negative news is released, the market does what the market always wants to do, which is go up. The top side is the better bet. Guys, I really appreciate your time in this video series, and I look forward to seeing you at the next one.